Imagine you're actively managing your portfolio's risk, and your ultimate goal is to engineer a completely smooth ride for yourself.
Right. No turbulence.
Exactly.
Yeah.
You want to scale your equity exposure up when the markets are calm, and then aggressively scale it down when things get choppy. The whole idea is to target a constant, predictable level of volatility.
And, massive pension funds, risk parity strategies, hedge funds, they run literally billions of dollars using this exact playbook.
Yeah, but making this actually work mathematically, it hinges on one deceptively simple question that honestly, most investors get completely wrong.
They really do.
Should you measure your risk using the market's forward-looking fear gauge, which is the VIX, or should you measure it using your portfolio's actual recent returns, which is known as realized volatility?
Yeah, it is the ultimate crossroads for anyone trying to perfectly balance crash protection with keeping their market return. Because a lot of portfolio managers, they just rely on tradition or like a gut feeling to choose their volatility signal. They rarely look under the hood at the underlying mechanics of what actually happens when these two signals collide with a real-world market meltdown.
Well, to settle this debate, we aren't just relying on theory today for this deep dive. We are tearing into an incredibly comprehensive empirical study.
Oh, it is massive.
It really is. It tracked 33 years of daily market data, stretching from 1993 all the way to 2026.
Yeah, we're talking about 17 different ETFs, thousands upon thousands of daily observations, and over 240 distinct strategy variants.
So the mission of this deep dive is to figure out exactly which mathematical signal you should use, when you should use it, and most importantly, the mechanics of why it actually works.
But I think before we look at how these signals perform in a crash, we need to, establish the baseline rules of the road for you.
Right. How does volatility scaling actually function in practice?
The formula in the data is actually quite elegant. Your daily market exposure just equals your target volatility divided by whatever volatility signal you're using.
Okay, let's ground that with some actual numbers. Say your target volatility is 10%. You want a relatively smooth ride.
Right.
If you look at the VIX, and the VIX is currently sitting at 20%, you just divide 10 by 20. That gives you 0.5.
Exactly. Meaning you are 50% exposed to equities, and you hold the remaining 50% of your portfolio safely in cash.
And that ratio is just constantly adjusting, right?
Constantly.
Yeah.
So if the market calms down and the VIX drops to 10%, 10 divided by 10 is 1, your exposure rises to a full 100%.
But wait, what if the market gets incredibly quiet and the VIX drops down to like 5%?
Well, the formula would tell you to lever up to 200% exposure.
Oh, wow. That sounds risky.
It is. To prevent things from getting dangerously unstable during those quiet periods, the baseline strategy in our source material places a hard cap on leverage at 1.5 times.
Okay, so you never go beyond 150% exposure, no matter how ridiculously calm the market looks.
Right, exactly.
Okay, the math makes total sense. But the entire formula relies on the denominator, right? The volatility signal itself. So why do the VIX and realized volatility behave so radically differently from each other?
It really all comes down to the perspective on time and, honestly, human emotion.
Okay.
So the VIX is a measure of implied volatility. It's strictly forward-looking.
Because it's derived entirely from the pricing of options contracts, right?
Spot on. It represents what hundreds of thousands of traders collectively believe is going to happen over the next 30 days. So it reacts instantly to fear, rumors, uncertainty, all of that.
It's essentially an anxiety index for the market.
Yeah, that's a great way to put it. And realized volatility, or RV, is the exact opposite.
Because realized volatility is entirely backward-looking.
Right. It's usually based on the rolling daily returns of the last 20 days. It doesn't care about predictions, doesn't care about the news cycle, and it certainly doesn't care about fear.
It simply measures how wildly the market's prices actually swung over the recent past.
Exactly.
You know, if driving your portfolio is like driving a car, the VIX is like having Waze on your dashboard.
Oh, I like that analogy.
Yeah, it's flashing red, warning you about a massive traffic jam 2 miles ahead based on like crowdsourced panic.
Right.
Realized volatility, on the other hand, is like looking out your rearview window. You only realize there was a massive crash because you literally just drove through the debris.
That analogy holds up perfectly, especially when you look at how the options market prices that forward-looking Waze system.
What do you mean?
Well, when you look at the 33-year time series charts in our sources, the VIX almost always trades significantly higher than realized volatility.
Yeah, the data shows this persistent gap of about 3 to 4 percentage points on an annualized basis.
Hmm.
But why does that gap even exist? I mean, if the VIX is supposed to predict volatility, shouldn't it eventually align with the actual volatility that happens?
You definitely think so,
Yeah.
but you have to consider the actual mechanism of the options market.
Okay.
The options market is essentially a giant insurance exchange. The people selling those options, the insurance providers, they are taking on an asymmetric risk.
Right, because if the market stays calm, they just make a small premium.
Exactly. But if a black swan event happens and the market craters, they are on the hook for catastrophic losses.
Ah, I see.
Because of that terrifying downside, those sellers demand extra compensation. They perpetually overprice the risk of a crash.
And that structural markup is what's known as the volatility risk premium.
You got it.
So if you're using the VIX to scale your portfolio, you are systematically overestimating the actual danger in the market because you are basically always paying that insurance premium.
Yes, systematically overestimating day in and day out. Because the VIX is biased upward by those 3 to 4 points, a VIX-based scaler forces your exposure lower on average. In the data for the S&P 500 using the SPY ETF, the VIX scaler was only 58% invested on average over the entire 33-year period.
So the signal is perpetually a little bit anxious.
Exactly, which means you're leaving money on the table during long, calm bull markets.
But I mean, the whole point of buying insurance is that you survive the disaster, right?
Right.
So let's look at what actually happens when the calm breaks. The researchers ran an event-time study isolating 87 distinct volatility spikes.
Yeah, these were days where the VIX jumped by 5 or more points in a single session.
They tracked how both signals responded from 20 days before the crash to 60 days after. So how much faster is the forward-looking signal?
The speed difference is literally the difference between keeping your wealth and losing it.
Yeah.
The VIX reacts instantly.
Instantaneously.
Yeah, on day 0 of a crash, it spikes aggressively, and it generally peaks within 1 to 3 days.
And realized volatility, stuck looking in that rearview mirror, barely even registers a blip on day 0.
Nope. The math of a 20-day rolling average means it doesn't even meaningfully start rising until day 5, and it doesn't peak for 15 to 20 days.
By which point your portfolio is already down, what, 20 or 30%?
Exactly. You can see this vividly in the charts for the 2008 global financial crisis.
Yeah, the VIX scalers saw the sheer terror in the options market and mathematically cut equity exposure to near 0 within days.
It got completely out of the way of the worst carnage.
While the realized volatility scaler took 2 to 3 weeks longer to fully de-risk, it just absorbed massive losses while it waited for the 20-day average to catch up to reality.
Yeah, during a systemic meltdown like 2008, every long-only strategy is going to bleed. But the VIX scaler provided drastically superior drawdown control.
It really did.
For the S&P 500, it cut the maximum drawdown from a devastating negative 55% down to just negative 23%.
Okay, here's where it gets really interesting, though. If the VIX saves your skin that effectively, why is this even a debate?
Right.
I mean, if realized volatility is guaranteed to be late to the crash, why would any institutional investor ever use it?
Because the options market has a massive blind spot on the other side of the crash. It's called the rebound trap.
Unpack that for me. What makes the rebound a trap?
Well, the VIX is phenomenal at getting you out of the market, but it is fundamentally terrible at getting you back in.
Interesting.
After a major crisis, the market's fear doesn't just vanish overnight. The options market stays highly elevated and deeply paranoid for weeks, sometimes even months, even as the actual stock market starts to quietly recover.
Ah, so the VIX scaler, obeying the math, just sits safely in cash and completely misses the early stages of the rally.
Exactly.
The Waze app is still screaming that there's a 10-mile traffic jam, even though the road ahead is actually completely clear.
That is exactly what happens. And this is where realized volatility really shines.
Because RV is looking at the actual calming daily returns of the market, so it realizes the danger has tangibly passed.
Right. As the daily swings get smaller, the RV signal drops, and it rapidly scales your exposure back up.
The COVID crash of 2020 is like the ultimate showcase for this.
Oh, absolutely.
The market fell off a cliff in March, but then we saw one of the most violent V-shaped recoveries in financial history.
And in that specific environment, realized volatility completely outperformed the VIX. The data shows the RV strategy delivered a Sharpe ratio of 0.82, while the VIX strategy only managed 0.70.
And for anyone not living in financial modeling software, a Sharpe ratio essentially measures how much return you get for the amount of heartburn you endure.
Exactly, yeah.
A higher Sharpe ratio means you got paid more for every unit of risk you took on. The RV strategy took some heavy damage on the way down, but it got right back into the market and captured that massive violent rebound.
Right, well, the VIX got out fast, but it stayed scared and missed the ride back up.
So you have a fundamental tension here. The VIX protects you on the way down, but creates a massive drag on the way up. Realized volatility hurts you on the way down, but captures the recovery. We are essentially left with two flawed signals.
Yeah, so if neither signal is universally perfect, how does an investor actually choose?
Well, the data reveals something totally counterintuitive here.
It does. The optimal signal doesn't just depend on whether the crash is a slow bleed or a V-shape. It depends entirely on the specific asset class you're trading.
Right, let's break down the 17 different ETFs they tested. Because for broad U.S. equities, like the SPY, the researchers found a third option that actually beats both.
Yeah, it's a strategy called Max4RV, maximum implied volatility or realized volatility.
Meaning every single day you calculate the VIX, you calculate the 20-day realized volatility, and you just plug whichever number is higher into your formula.
Exactly. You always trust the more terrified signal.
The logic is brilliantly simple.
It is. If the options market is panicking about the future, you trust the VIX and scale down. If the options market is calm, but the recent actual returns are wild, you trust realized volatility and scale down.
And by defaulting to the highest measure of risk, the strategy achieved a massive Sharpe ratio of 0.84 on the S&P 500.
Delivering the most robust all-around protection across 33 years of radically different market environments.
That makes perfect sense for broad equities. But what happens when we shift our focus to fixed income and credit? The study tested ETFs like LQD for investment-grade corporate bonds, TLT for long-term treasuries, and HYG for high-yield corporate debt.
Well, for every single fixed income and credit asset, the VIX dominates entirely. The VIX is unequivocally the best signal to scale a bond portfolio.
Wait, hold on. The VIX is literally an S&P 500 index. It is derived entirely from stock options. You're telling me to use stock market fear to protect corporate bonds? That sounds like mixing apples and oranges.
It does sound like that, yeah.
If the bond market has its own unique dynamics, shouldn't it have its own dedicated volatility signal?
You would naturally assume so, but you have to look at the underlying market structure and the capital stack of these companies.
Okay.
When a true systemic panic hits the financial system, equities are almost always the very first asset to react.
Why is that? Why do stock traders panic before bond traders?
Two main reasons. First, liquidity. The equity markets are deeply liquid, so it's much easier to dump stocks instantly when bad news breaks.
Right.
Second, the capital structure. Equity sits at the very bottom of the capital stack. If a company goes bankrupt, the shareholders are wiped out completely before the bondholders lose a single penny. Because stock investors carry the ultimate risk, they have the twitchiest trigger fingers. The bond market has a buffer, so it reacts just a little bit slower.
So by using the VIX to scale your bond portfolio, you're basically using the stock market as a canary in the coal mine. You are reacting to the equity panic and de-risking your bonds before that panic fully bleeds into the credit markets. That is a fascinating cross-asset hack.
It's incredibly effective.
But does that logic hold up when we look at specialized sectors? Like, what about high-beta technology stocks like the QQQ or XLK ETFs or commodities like gold?
Actually, the logic flips completely there. For high-growth tech and for gold, the VIX is a terrible signal. The 20-day realized volatility wins hands down.
Why does the VIX fail so badly for tech? If tech stocks are just riskier equities, shouldn't an equity fear gauge work perfectly?
The problem is a mismatch in baseline volatility.
Okay.
Think about the nature of high-growth tech companies. They are naturally persistently more volatile than the broad S&P 500. They swing wildly based on earnings, interest rates, innovation cycles.
Right.
If you take the S&P 500's implied volatility and apply it to a tech ETF, you are applying a conservative, broad market fear gauge to an inherently jumpy asset.
Oh, so you end up treating normal, healthy tech volatility as a systemic emergency.
Exactly. The formula sees the higher baseline volatility of tech, assumes the market is crashing, and forces you to sit heavily in cash.
And then you miss the gains.
Yeah, you end up severely underinvested in a sector that requires you to hold on through those wilder swings in order to capture the massive upside growth.
So the cost of lost exposure in tech vastly outweighs the benefit of the crash protection the VIX offers.
Precisely.
And for gold, you have an asset driven by inflation fears, geopolitics, and currency moves things. An S&P 500 options index simply isn't designed to measure.
Exactly.
So the rule of thumb here is crucial. Context is everything. You cannot just copy-paste one volatility signal across your entire portfolio. You have to match the mechanism of the signal to the mechanism of the asset class.
But, having these theoretically optimal pairings is wonderful for a white paper. But the researchers also stress-tested this in the real world. And in the real world, every single time your volatility signal changes, you have to adjust your exposure. You have to actively buy or sell the underlying asset.
Which introduces the massive friction of trading costs.
Oh, yeah.
When I was reading through the data on realized volatility, I noticed they tested multiple different look-back windows, like 60-day, 20-day, 10-day, and 5-day averages. My immediate instinct was, well, if a 20-day realized volatility window is too slow to catch a crash, why not just shorten the mirror?
Right. It seems so logical.
Yeah, why not use a hyper-responsive 5-day window so the system reacts almost instantly to a market drop?
It seems like the perfect logical workaround, but the data shows it absolutely destroys your portfolio.
The numbers are brutal. The 5-day realized volatility signal dropped the Sharpe ratio down to 0.65.
Wow.
That is significantly worse than just buying and holding the S&P 500 and doing absolutely nothing. Why does a fast signal fail so spectacularly?
It's the turnover trap. A 5-day window is incredibly noisy. If the market has just one exceptionally good day or one exceptionally bad day, it radically alters that 5-day average.
Ah, I see.
Consequently, your target exposure formula is violently whipping back and forth every single day. The data showed that a 5-day RV strategy results in an annualized turnover of 26 times.
Wait, 26 times a year?
Yes.
That's insane. Using a 5-day RV is like constantly switching lanes in a dense traffic jam. Every single time you switch, you pay a toll in the form of bid-ask spreads.
Exactly. Even if you're using a zero-fee broker, the hidden cost of crossing that bid-ask spread 26 times a year guarantees you will run out of gas.
The constant friction just eats all of your alpha.
The best theoretical signal is entirely worthless if it's too expensive to trade. The VIX, by contrast, only turns over the portfolio about 7 times a year.
Much more reasonable.
It's a much smoother signal because implied volatility moves in clearer trends.
Okay, so a hyperfast RV is off the table. The VIX is great but misses the rebounds. Max FI RV is incredible for broad stocks, but maybe calculating 2 different signals every day is just too complex for an everyday investor.
Yeah, it can be a lot.
What is the most practical, robust approach for someone actually trying to implement this?
Well, the researchers synthesized 2 incredibly robust paths based on the 33 years of data. If you don't want to run the Max 4 RV strategy, the most practical alternative is the hybrid 50-50 approach.
How does the hybrid work?
It's an elegant compromise. You simply take the VIX and the 20-day realized volatility, and you average them together into one single number.
Oh, okay.
By blending them, you inherit the fast de-risking properties of the VIX during a crash, but you also dilute that lingering fear with the faster re-risking properties of the realized volatility during the rebound.
It smooths out the extreme flaws of both signals. And looking at the results, it delivers a Sharpe ratio of 0.80 on the SPY with very manageable turnover.
It really seems like the most stable, set-it-and-forget-it choice across almost every market regime.
But what about the logistics of actually executing the trades? How often do you need to rebalance your account to make this work?
Mathematically, recalculating and rebalancing your exposure daily provides the absolute highest risk-adjusted returns.
Daily? That's a lot of work.
It is. However, the data shows that rebalancing weekly is extremely close in performance, and it cuts your trading friction down significantly.
Oh, that's good news.
But there's a massive warning in the data. You must avoid monthly rebalancing.
Yeah, that makes intuitive sense. If you only check your volatility formula once a month, a black swan crash could happen on day 2.
Exactly.
You would spend 28 days bleeding out, completely fully invested, before your system finally wakes up and tells you to move to cash. Monthly is just too slow to be considered a crisis response system.
And we have to reiterate the importance of leverage caps. If you decide to implement this, you have to cap your maximum exposure.
Right.
If you leave your scaling formula uncapped, you amplify both the good and the bad. The strategy becomes dangerously unstable during deeply calm, multi-year bull markets.
Because when volatility drops near 0, the math will blindly tell you to lever up 3 or 4 times.
Exactly. Stick to a sensible 1.5 times cap so you actually survive the inevitable transition from calm back to chaos.
So, to distill 33 years of data, 240 strategies, and 17 different ETFs into the core takeaways for your own portfolio toolbox.
The most important finding from this entire stack of research is that volatility scaling fundamentally works.
Yes. Out of the 17 ETFs tested across equities, bonds, tech, and gold, every single one of them showed a positive risk-adjusted improvement from scaling compared to just blindly buying and holding.
It is a remarkably uniform finding across entirely different asset classes.
It's important to understand it's not a magical free lunch. You are giving up some raw top-line percentage returns because this strategy forces you to sit in cash during periods of high fear,
True.
but you are trading that raw return for massive structural drawdown control. You are mathematically cutting your worst-case scenarios in half, and the Sharpe ratios prove that trade-off is overwhelmingly in your favor.
Yeah, just remember to watch your turnover by avoiding hyperfast signals and match your tool to your asset. VIX for bonds, RV for tech and gold, and a hybrid or max signal for broad equities.
Perfect.
But, before we close the book on this data, there is one lingering detail that isn't explicitly answered in the white paper.
Oh.
Yeah, but it raises an incredibly important question about the future structure of the market itself.
Okay, let's hear it.
Well, we just spent this whole deep dive proving how incredibly effective this mathematical strategy is. It mathematically wins.
Right.
Because of that, it's inevitable that every major algorithmic trading desk, every massive pension fund, and eventually every sophisticated retail investor might start perfectly scaling their exposure using these exact same VIX signals.
Oh, I see where you're going with this.
Which brings us to a paradox. What happens when a minor geopolitical hiccup causes the VIX to jump 5 points, and suddenly trillions of dollars are mathematically forced by their algorithms to sell equities and move to cash on the exact same day, at the exact same minute?
Wow. Does the act of everyone automatically dumping equities the second the VIX spikes become the very mechanism that triggers the next catastrophic market crash?
Exactly.
If everyone is using the same radar to avoid the pileup, do they accidentally cause the pileup? Are we actually solving systemic risk, or are we just synchronizing it?
It is the ultimate paradox of risk management. When everyone buys the exact same insurance policy and everyone rushes the exits at the exact same time, the exits become the most dangerous place in the building.
That is a fascinating thought to mull over the next time you're checking your portfolio allocations. So whether you choose to use the forward-looking radar of the VIX or the rearview mirror of realized volatility, or blend them both together to keep your drive smooth, we want to thank you for joining us on this deep dive. Take these insights, rigorously apply them to your own portfolio planning, and keep your eyes on the road ahead.